And the government has in fact set the borrowing number for April to September at 8.45 lakh crore rupees. That's approximately 55% or close to 55% of the gross borrowing number for the full financial year. Joining me now to tell you what this means and the implications of this is Mythili Bhusnurmath. Mythili, we were speaking about this a little earlier in the evening, and I think the broad consensus was that if they reduced it from what they normally did, which is to front load it, the market would look at it positively. What's your view?
Yes, absolutely. But the government clearly hasn't, because the government now, as per the calendar that has just been released, which, as you said, we were waiting for all evening, the number that the government is going to borrow approximately, 59 to 60% of this entire borrowing for the entire year in the first half. And this is the practice in the past. And usually that would have been, the markets would have accepted that and expected that as well. But this time around, there was the view that maybe the government would reduce its borrowing in the first half, precisely because it has a large cash balance at the end of the year. They're likely to have a large cash balance at the end of the year, and also because that would give the RBI some elbow room. Remember, in the past, RBI has been supporting the government's borrowing program hugely by flooding the market with liquidity in a bid to keep interest rates down. Now, with inflation inching up, the RBI will no longer be able to keep monetary policy as loose as in the past. So even if they do not tighten it by raising the repo rate, they would certainly have to keep it less easy than before, in which case the yields would rise even more than anticipated. Already we are seeing 10-year bond yields at 6.8%, which is much, much higher than RBI's earlier hope of keeping it fixed at about, targeted roughly at about 6%. So clearly the fact that the government is going to be borrowing much more than what the market anticipated is going to put pressure on yields. Tomorrow when the market opens, we will see a sharp uptick in 10-year yields, and RBI will have a tough call. Given the fact that the next monetary policy meet is between the 6th and 8th of April, it will be difficult for the Monetary Policy Committee to take a view really. And how are they going to satisfy the government's gargantuan appetite and at the same time keep price stability, which is the RBI's foremost objective up front. So it's going to be a tough call. RBI governor will have to do some more tightrope walking, even more than in the past, because this clearly is a number much higher than what the market had anticipated.
Thanks so much, Mythili, for joining in and for sharing that perspective. Certainly something to watch out for. The bond yields, as Mythili said, tomorrow are going to be something that you will have to very closely monitor. They have been trending higher. They've gained quite significantly over the course of the last financial year as well. And now there are expectations that the 10-year benchmark government bond yield could go as high as 7%.